For those who are joining us today, if you could just please go ahead and mute yourself as you're coming into the room, that would be greatly appreciated. During this call, you will have access to your microphone and chat box. We do highly encourage participation, so if you have any questions at all, please go ahead and put them in the chat box. Either Crystal or I will go ahead and answer them and make sure that Crystal or Cheryl does see them at some point. She will stop and ask if you have any questions, and we can address those questions at that point as well. If you're coming in through a web browser, we have noticed that there is a significant difference between the app and the web browser, just technical difficulties wise. Some people aren't able to access their chat boxes with their web browser, but do have access throughout the app. So I do encourage downloading the app. With that being said, Cheryl, would you like to take over?
I sure can. Thank you, my girl. Okay, so welcome to today's, and is it showing fine, my girl?
Yes, it is showing fine.
Okay, welcome to Admissions and Occupancy Day 3. I think this is the hardest day of the week. For me anyway, as an instructor. This is brought to you through the Native Learning Center. Welcome and good afternoon. I just went and smudged. We definitely need it for all our family and friends and people at the Native Learning Center and everybody in Florida. I've got somebody that's got to...
Yeah, guys, sorry, please make sure you guys are muted as you're entering the room so that Cheryl can go ahead and continue the presentation. Thank you.
Thanks, Crystal. So welcome and good afternoon. This is my information. Should you guys need anything, and you'll be able to find it after the end of the presentation also.
Yeah. And
this webinar is being recorded. This is my information. I believe most of you have been here all week. Again, my name is Cheryl. My Anishinaabe name is Redbird Woman, and I am Loon Clan from Kenoshinconning, which is Bay Mills, place of the Pike. And our reservation is in the Upper Peninsula of Michigan. Our waters border Canada, and we are Chippewa or Ojibwe people. I served as my tribe's director of housing for 28 years and the chairwoman of the National American Indian Housing Council for 4, and an additional 12 years as vice chair and secretary. I also was with the Great Lakes Indian Housing Association as their chair for 7 years. So we're working on admission and occupancy. We made it through right to the middle of the week right now. So hopefully you're learning things, and we're going to go through and the course objectives. Hopefully we're hitting on some of them, knowing the process and the importance of, verifying applicant information and what should be yesterday, hopefully, included in your admissions occupancy policies. And today we're going to work again on calculating annual income for our assisted programs. So determining income eligibility and calculating adjusted income. Tomorrow we'll hit it harder on various subjects, but like I said, this one will work a little bit longer on. So this is income under NAHASDA, annual income as defined within 24 CFR Part 5. Whose income to count, types of income to count, income from self-employment, no income or not enough income, Social Security income, calculating annual or alimony and child support, child custody and support payments and the computations, the different ones that can take place, military pay, methods for computing Part 5 annual income or the assets or no assets, and anticipated annual income tips and a practice summary. What to include as an asset, assets owned jointly, income from assets. There's 2 unique rules. When assets are disposed of at less than fair market value, and summary of the items that need to be considered when you're calculating that income. We're going to hit upon those definitions of income, that US Census definition of income, the Internal Revenue Service, the IRS, and comparing those three definitions. And then whose income counts in that house? Your NAHASDA allowances, your allowances for your dependents, your families that are actually sharing custody, what you do in those circumstances, your elderly and your disabled deductions, and your medical and attendant expense deductions. How we adjust that annual income, how it's calculated for an elderly and disabled household, or for those childcare expenses, earned income of minors, excessive travel, and some of those other amounts. Total tenant payment. So if you ever see that TTP, that's what that stands for in that computation. Your low income, total tenant payment computation issues, people that try to charge, your flat rents or less than 30% of adjusted income, when a family is actually considered low income, and calculating assistance for your non-low income families. So section 4 is going to be dealing with determining income eligibility. And the income under NAHASDA, as we discussed in the last couple of days, one of the criteria for eligibility of admission is the amount of annual income that a family earns. It's going to tell you how you're going to deal with them, even if you can help them at all, and if you have to let HUD know about it before you decide to give them assistance. There's an exhibit 4.1 that shows the income from all sources for each member of the household as determined in accordance with criteria prescribed with, by HUD. Except the following amounts may not be considered as income under this paragraph. So this is actual coming from guidance. That's why it reads this way. Any amount not actually received by the family, any amount that would be eligible for exclusions under 1613 of the Social Security Act. So that tells you should have the language for that in that binder that I was talking about putting together. Any amounts received by any member of the family as a disability compensation under Chapter 11 of Title 38 of the U.S. Code, or dependency and indemnity compensation under Chapter 13 of such title. So there's a list of all these different things that you waive basically as income. And those are the ones that I'd like you to, keep in a binder. Just so you don't have to, always search, the one I was talking about yesterday and that treaty related income. Well, you could, make that statement that, hey, we don't have anybody that gets that kind of money on our reservation. We don't need that. Well, what happens if Cheryl comes to your reservation and moves in with one of your gentlemen, or one of my friends that live there? Then I would actually be entitled, to that deduction, or that you wouldn't count that. So you need to always keep track of all the deductions, even though you don't think you're going to have anybody that it should ever apply to. So you do not need to limit your definition to only one of those three outlined, For example, the policy could state the recipient may use a definition most advantageous to the family or the housing entity for purposes of determining eligibility. Or you could say, most advantageous to your housing entity. Okay, so, but you're supposed to define which one of these three methods, Section 8, US Census, or IRS, that you're going to use. And what I was telling you about is at some point you're going to get HUD monitoring, and the first place they hit is your occupancy files. They're going to see if the person was eligible when you put them in there. They're going to see if you're charging them the right amount. And they're going to see if when you came up with that calculation, you did it correctly. They're going to monitor a certain amount of your files. This is why I encourage people that if they should run another tribal program, whatever it be, don't intermingle your files. Keep all your NAHASDA related 1937 Act files in one location away from everything else. Because otherwise they're going to do a sampling of the overall amount of files in that area, okay? Another way just to make it, and do have your staff members pull, some of the things for self-monitoring and check your files yourself. And if you can't find proof that they were eligible, if you never put it in the file or they weren't eligible or whatever, put a big sticker on that file and say, we discovered it during our self-monitoring and we're going to do better. And this is how we're going to fix it by continually, pulling an amount of files. And then it's not going to be, oh, look what we found. It's going to be, oh, look what they discovered and they fixed, so don't hide things, put them out there, make it part of your self-monitoring or whatever, because like I said, it very well could have happened before you even got there as a director or an employee. But they're going to go back and they're going to check to see if they were eligible at admission right from whenever they got in there, regardless of who was in office. Okay. So you have to keep that proof of eligibility, always move it from file to file, and then make sure that those calculations were done. So if you use one of those definitions, saying that we could use whichever one is most advantageous, well, then you have to additionally prove that you've ran that calculation using all three methods. So it's a lot more work for you as an entity. So I actually wouldn't encourage an occupancy department to use that definition. And then you better make sure that you're always making it so the one that's the most advantageous is the one that you've used, just to keep you out of trouble. So you actually exercise your right of self-determination by choosing that definition. Just make sure that if you're going to use the multiple one, that you're doing that multiple work and you have proof of it. You have to keep it there. So annual income is defined under 24 CFR Part 5. Annual income definition provided in Appendix 14 is used by numerous federal programs, including NAHASDA. Annual income is used to determine our eligibility and the level of assistance in some cases that a household will receive. What do you mean by that? Well, when somebody's over 80% of income, they can't receive unless they were, let in as a low-income person. If you come in over 80% of the income from the get-go, that you can't receive the same amount of assistance as somebody that's determined as low income. So you have to do a different calculation. So it does determine the level of assistance that household is going to receive. The definition of annual income is that gross amount of income of all adult household members. Your gross income or your gross pay is an individual's total earnings before taxes or other deductions. I know gross and net sometimes screws people up, including myself in the past, so your gross amount for those amounts of income counted, any deductions before any deductions are taken, income of all your adult household members. The definition of annual income contains inclusions, types of income that you count, and exclusions, which are types of income that you don't count. Anticipated to be received. Part 5 annual income definition is used to determine our eligibility and the amount of federal assistance that a household can receive. You, as a recipient, have to use their expected ability to pay rather than past earnings when estimating your housing assistance needs. So knowing whose income to count is as important as knowing which income to count. We have an exhibit at 422 which summarizes whose income would count under Section 8, for example, for the purposes of calculating income under NAHASDA. Under Part 5, the definition of annual income special consideration is given to income earned or unearned by the following groups of people. So minors, earned income of minors is not counted. However, unearned income attributable to a minor, child support, TANF payments, other benefits paid on behalf of a minor is included. Foster children and adults, and they mean a foster adult. These persons are included in your household member count, but foster children's earned income is not counted. However, unearned income counts as income. Foster adults' earned and unearned income counts as income. And you can't give a deduction for a foster child, that dependent deduction. They don't receive that. Your live-in aids. If a household includes a paid live-in aid, whether paid by somebody in the household or the government or a social service program, the income of that live-in aid, regardless of the source, is not counted. So persons with disabilities, during your annual recertification process of a household's income, recipients are required to exclude from annual income certain increases in the income of a disabled member, of a qualified family residing in a NAHASDA assisted unit, or receiving tenant-based rental assistance, TBRA. Adult students living away from home. If the adult student is counted as a member of that household, you qualified because you were a family of 6 and you earned this amount of income. In determining their size, especially under your HUD income limits, the first $480 of that income is counted toward the family's money, toward their income. But they can make $50,000 a year and you don't count the rest of it unless they're in one of those key positions. And we'll hit upon this again in a different slide. Your rules are always different for the head of household, the co-head, or that other significant other, up in that primary spot. The rules for those ones are different than everybody else. So as long as they are not, the head of household or the co-head, you only count that 480. Then they can make whatever. Unfortunately, if they're a working student and they're one of those primary positions, you have to count it all. So that limit does not apply to a student who's the head of household or spouse. His or her full income has to be counted. To count the adult student as a household member, the adult student would need to be verified as a dependent, usually on the parent's tax return. Now, remember, that's what I was talking about yesterday. My son started working when he was 17. I would have never been able to count him as a dependent because he started filing his taxes too, because he knew the value of a tax return. So if they're doing that, then you can't really qualify them, unless they're counting them as a dependent on their tax thing and they're allowing it. You can't do that. So additionally, student status actually should be verified with documentation in the file, and we're going to address that later. So temporary absent household members. The income of a temporarily absent household member is counted in the definition of annual income, regardless of the amount the absent member contributes to the household. So my old man, husband, whatever, he right now, like I said, he was a commercial fisherman. They don't get Social Security. So when he hit 50, it was like, hey guy, you got to get something where you're going to get Social Security when you get older. So now he's driving a truck. He's around here, but if he was an off the road trucker and gone, it doesn't matter. You would have to count that income, even though he might only sleep in, once every 3 months, make it home or whatever, temporarily absent. If you've got him on all your paperwork and you used him, to count, to determine that household size, you have to count that income, even if they're temporarily absent. So the persons counted in a household size for the purposes of eligibility, your head of household, you're going to count their employment income and any other income they receive. Same thing for the spouse. Same thing for what they call a co-head. I lived with my husband probably I was engaged 15 years before I finally married him. So he was a co-head. He was not my spouse, but he was in that primary spot for all those years, So your other adults, you count them both, When it gets down to your dependents, do you count their employment income? No. Do you count their other income? Yes. Children under 18, same thing. You don't count their employment income, but you do count that other income. Your full-time student, it depends on if they're in that co-head or head position or not, okay? The rules would be different there. A foster child under 18, you don't count their employment income, but you do count other income. Same thing, a live-in aid, a foster adult, you count everything across the board. A live-in aid, you don't count anything, employment income or other income. They just live in there free of, you kind of forget they exist. So Exhibit 4.3, a construction worker employed at a temporary job on the other side of the state earns $600 a week. He keeps $200 for his expenses and he sends $400 home. The entire amount, you would still have to, if they're only getting $400 of that, but you would still have to count that entire income. Unless specifically identified as a temporary or a permanently absent household member, recipients should determine if a unique household situation would be considered permanent or temporary. Now, because you're a sovereign, should you have a program like a wildland firefighter or something like, something where it's requiring them to go away for 9 months of the year or something like that, to get their training, you can always make a change that would affect, a lot of your tribal members that maybe for that period of time, you wouldn't count their income, something like that. But you always have to, weigh that cause and effect. What's this going to do to my subsidy? And make sure that your governing body agrees with it and it's in your meeting minutes and it's duly passed in a meeting. Then you can make your own deductions, or, allowances that you would not count. But you have to make sure that it's done properly. So permanently absent household members, if a household member is permanently absent from that household, a spouse who is in a nursing home, the head of household who has the choice of either counting that person as a member of the household and including their income attributable to that person, or specifying that that person is no longer a member of that household and taking them off the lease, and then you wouldn't have to count it, okay? So types of income to count. A comprehensive list of income that is included and excluded from calculations of annual income. Part 5 is updated by HUD when changes are made by Congress. The newest guidance was 2013. It's 2013-05, and it's in your appendix items. Calculating annual income for purposes of eligibility under NAHASDA. So that's Appendix 4. That's another document you should print off and have in that binder, okay? There is Program Guidance 2013-05 that explains lump sum periodic payments and those other deductions, like, I was talking about my treaty-related income due to a land settlement, or the Eloise Cobell monies, statutorily excluded. It goes back to 2010. But you don't want to have to go looking for that stuff all the time. Once you come across it, you put it in that binder and you make an exclusion section, or however you want to mark it, so anybody incoming into your department will have access to that. So payments may not be counted as part of that individual's income for purposes of determining their initial eligibility. Okay, so they would be at a lower threshold going in, or ongoing eligibility, or level of the assistance. NAHASDA identifies the following income exclusions. Any amount not actually received by the family, any amount that would be eligible for exclusion under Section 1613A7 of the Social Security Act, It relates to certain amounts that are received from the United States that are attributable to underpayments or benefits due for one or more prior months of Social Security. Any amounts received by a member of the family as a disability compensation under Chapter 11, Title 38, dependency and indemnity compensation under Chapter 13 of the same title, and it relates to amounts received from the Department, VA, by a family for service-related disabilities of a member of a family and survivor benefits. 13 includes PIHA Notice 2011-15, so that's another notice that you would want in your binder. Implementation of statutory change to the Native American Housing Assistance, or NAHASDA, related income, which was extended by the PIH Notice 2012-5. So whenever I keep mine in a big binder, right back, right here. This is only one of them. I have one for PIH notices and one for program guidances. Whether you make it your front desk person or somebody needs to be online once a week checking that HUD website for our guidances. Once you have them, you don't kill so many trees if you do it all the time, but you keep them. And you keep them by year. I have the same thing on the shelf for the PIH. This is just the program guidances. You see how far they go back. Now, if one takes the place of another, I would go to it and say replace by on the document. But you should have anything that's related to occupancy in that binder that I was talking about. Not necessarily this particular binder, but this other binder that I was telling you about. See, I did that on one of my Native Learning Center presentations, and that particular platform had no camera, so nobody could see it. And there I was showing everybody, and I was embarrassed. But so it excludes any payments that are expressly excluded from annual income under those NAHASDA exclusions, and a sample of types of income that can be included or excluded from the annual income definitions is provided within Exhibit 4.4. So employment or income from self-employment. That's when it really gets fun. The net income from the operation of a business or profession, including self-employment income, is used to calculate annual income. Net income is your gross income less your business expenses. Interest on loans, depreciation, computed on a straight line basis. There's important considerations when calculating net income, and they include, in addition to net income, any salaries or other amounts distributed to family members from the business, and cash or assets withdrawn by family members. You're supposed to include that. That's supposed to be counted, except when that withdrawal is a reimbursement or of cash or assets that are invested in the business. Okay. Principal payment on loans, interest, loans for business expansion, capital improvements, other expenses for business expansion or outlays for your capital improvements must not be deducted when calculating net income. If the net income from a business is negative, it must be counted as zero income. Okay. A negative amount must not be used to offset other family income. So you can't say I went $20,000 in the hole starting my business, so take 20,000 off my husband's income. It doesn't work that way. In the case of self-employed individual who has just started a business, the recipient should ask the individual to estimate what the net income is that he or she expects to earn from that business. You may need to assist the individual in making this determination by asking him or her how much they expect to make, what expenses a business is expecting to have over the next 12 months. Now, unless they're just brand new to starting it within, a couple of months, as a business owner, you normally have a very good idea about what you're going to make or what your projections should be because of the fact that you're either tracking it for your taxes, or in my case, I just sit down with an accountant and say, okay, I made this much this year. I imagine I'm going to make this, and I base quarterly tax payments on that amount. So you have a fairly good idea usually of what you're going to make in a year. If you're making pies or something like that, just a little teeny side job, well, then it's going to be a little bit different. Okay. And you got rules for that coming up also. So, no income or not enough income. You always have those people that I don't make any money. Oh, damn, you just pulled out a cell phone. I saw you in the casino gambling, when you hear that and then you walk someplace and see them sitting in the restaurant, or they're in the restaurant 5 times a week, and you're working 40, 50 hours a week and only can go once a month, you kind of wonder how they can, how they can do that. Careful assessment is required when an applicant states that they have no income, or the stated income is not enough to cover their household expenses. It's important to note if that household expense is paid and current, or if they remain unpaid. It's a clear indicator of whether there's truly no income or not enough income. And third-party verification should be required, including the verification of Social Security benefits, a printout of that record, verification of unemployment benefits, notarized statements of non-filing for federal income tax, verification of assets on deposit, and a review of a checking account statement that may show frequent deposits, which could, indicate income. You have you can ask for that. So this is Exhibit 4.4. It's examples of income included when calculating your total gross income. Employment income, Social Security income, TANF, Tribal General Assistance, alimony and child support, Alaskan corporation dividends, reoccurring gifts, unemployment benefits, workers' comp benefits, permanent fund dividends, per capita payments from gaming activities, okay? It's important to know what that per capita is given for from the tribe. Per cap from tribal trust land, like I was talking about myself, that's, not counted. That first 2,000 per individual exclusion. It only applies to the per cap payments whose source is derived from tribal trust land. Examples of income excluded when calculating household gross annual income: you never count food stamps. You don't count Section 8 rental assistance, foster care payments, hostile fire payment to your military members, student financial aid, reoccurring payments paid directly to a child care provider by a person that's not living in the home. Amounts specifically excluded by any other federal statute, including lump sum periodic payments received by an individual native in the case of Cobell versus Salazar. Those Cobell statement payments are statutorily excluded pursuant to the Claims Resolution Act of 2010. The exemption attaches to the payment and applies for a 1-year period from that payment. Payments cannot be counted as part of the individual's income for purposes of determining initial eligibility, ongoing eligibility, or level of your IHBG assistance. For more information on that, you'd go back to that guidance at 2013-05. Veterans benefits excluded from income under NAHASDA are found under the PIH Notice 2011-15, compensation for a veteran, any member or his or her family for service-connected disability or death under Title 38, Chapter 11, dependency and indemnity compensation for service-connected deaths is excluded from the calculation of income for determining program eligibility under NAHASDA. So those are ones that you're going to put in your binder. So an assessment of all information available will allow you as a recipient to make an informed decision to either accept or deny an application for assistance. Refer to that exhibit at 4.5 for an example of your verification suggestions. Appendix 15 provides a sample questionnaire to be used when you're verifying no income. Exhibit 4.5, a declaration of no income, declaration of no income issue. Husband, wife, and 2 children apply for assistance. The wife is not on any tax returns. She has no verifiable income or any sort of a paper trail to use as documentation. What alternative documentation is required to prove she is without any income to contribute? Your recommendation there would be both adults should sign a third-party release of information before proceeding to verify that applicant's zero income claim request, the IRS form 4506T to verify either income or non-filing for federal income tax, verification of Social Security benefits or a printout of the record, verification of unemployment, verification of assets on deposit, start with the same bank as the spouse, and, credit report. So your Social Security income, certain rules apply in your assistance in determining the correct monthly amount to use when calculating income for Social Security benefits. Use the monthly amount before the Medicare amount is deducted. Use the monthly amount after adjustments for past overpayments, if there was any. Use the monthly amount with the expected cost of living or that COLA included if the COLA has been announced by the time you were qualifying that individual. COLA is usually announced in October by the Social Security Administration. Social Security benefits can be delivered to the recipients via a direct express or a debit MasterCard account. It creates a scenario where you would count the income being received from Social Security, count the balance on the cards as an asset. You are not double counting because you would only count interest that's being earned on those card balances, if any. Just as you would count the interest on any Social Security funds that they would deposit in an interest-bearing checking account. Alimony, child support income, the calculation of that. Alimony and child support that have been awarded to the court by the court has to be counted unless that person that's designated to receive those payments can demonstrate that he or she is not receiving the payments and has taken legal action through the courts or child enforcement agency to attempt to collect the payments. Now that's the key to that, okay? They have to actively be trying to pursue that payment and be able to, provide you a note from the tribal court or the state court or whatever, showing that they are trying to receive those payments. If the recipient has a court order and is not receiving any payments and they have not attempted to enforce collection, then you have to use that full amount of that court-ordered support to calculate the income, the household gross annual income. But if you can get the letter showing that they're trying to pursue it and they're not getting it, you can actually count what they actually receive, okay? But they have to actually try to pursue that within the court. So if the recipient has filed the proceedings to collect the court-ordered payment, they're receiving a lesser amount that was awarded by the court. The lesser amount can be counted if that third-party verification can be obtained, documenting the enforcement attempts. If the support is being paid through the welfare agency, the family may not receive the full amount of wealth as the welfare agency will use part of the funds to offset the cost of those welfare benefits that the individual is receiving. The individual entitled to receive the child support may receive what is known as a pass-through amount instead of that full amount that the court has ordered, in the form of child support. In those cases, only the pass-through amount is counted toward that household income. Okay, you don't hit them for that whole amount. Child custody and support payment computations. So calculating annual alimony and child support, court ordered, full amount, you include it all. Partial amount, third party verification, use the sum of what they got in the last 12 months. Arrearages, third party verification, you use the sum of what they got in the last 12 months. No payments, a third party verification, if received in the past 12 months. If not received, don't count it at all. If it's not court ordered, you have the family enter the amount expected to receive in the next 12 months on a child support affidavit. Have the family enter the amount expected to receive for the next 12 months on a child support affidavit, if they get that full amount or that partial amount. If they're in arrears, it's not applicable. If it's under no payments, you have the family complete a child support affidavit. So Wendy has a court order requiring her ex-husband to pay $200 a month in child support. Wendy has pursued collection through the local child support enforcement agency, which provides a printout showing what she has received for the past 6 months. How is the income for that child support calculated? And I lost my screen, so I really can't see you guys' responses. You should be adding up all 6. You should come up to $275. You take the total amount received for 6 months. You make that division of, comes down to 45.83. Multiply that times 12. You would count $549.96 rather than $2,400, which would be the 200 at 12 months. They come out a lot better that way. So Jada has a court order which awards $250 per month in child support for her 2 children. The father, who is ordered to pay, has not been paying child support at all. And Jada has made no attempts to collect the support. Is the $250 a month counted toward the household income? I have to see. I can't see my chat box right now. It disappeared. There we go. Okay. What do you guys say? We have a yes, we have a no. No. Come on, couple more, yeah, if you would. Colby, yes. Okay, now we're tied at yes and no. No will need a 12-month proof of no payment received. Couple more. No. Yes. You guys are mixed crowd there. Okay, remember the rule. She has to have proof that she went after that money. If she didn't try to collect it, you have to hit her for the whole thing. Okay, depends. Did she try to collect it again? Yes, Mariah, you are correct. It says right there she has made no attempt to collect the support. So unfortunately, that's her fault. She's trying to be the nice guy. So you have to slap it, for the whole thing. Okay. Are you? Wait a minute. I apologize for that, guys. Military pay. All military pay is counted except for hostile fire pay. The Housing and Economic Recovery Act 2008, which is HERA, included a special provision that allows for the exclusion of housing assistance pay in some counties that have military bases nearby. There's an IRS notice 2008-79, 6, which contains a list of military bases confirmed by the IRS to have met requirements necessary to allow for exclusion of that housing pay. That notice also states the following list is not meant to be exclusive, and any qualified military installation with the meaning of 142 B2, B4, which satisfies the percentage requirements, would be eligible to receive similar treatment regardless of its failure to be included on that list or in any future updates. Therefore, if you live near a military installation, it may not qualify for the housing pay exclusion, even if it's not listed, or it may qualify. Okay. So, that was something that you should call your HUD office if you don't know, these are some right now. If you're around, in Colorado, the Air Force Academy, if you're in Kansas around Fort Riley, if you're in Texas around Fort Bliss or Fort Hood, Virginia, Dam Neck Training Center in Atlantic, Washington, the Naval Station at Bremerton. But I would find out, because I'm sure this list is a lot bigger by now. But if you have people that, this is another little bit of guidance or whatever that you'd stick in that book. And if you have somebody come in under that certain, you do a little bit more investigation. And when you can't find something out, you call the HUD office, pick them up. I can recite the Eastern Woodlands phone number right now, I'm, because everything else is usually programmed into a phone, but you always call for help. If you can't find an answer, they'll help you, they'll help you find that answer. So by all means, use them. And the other really weird person to use is your auditors. I used to do that all the time. Hey, can I do this? I would rather do that than do something without, permission or whatever and find out that I did it wrong. They might say, yeah, you can, but you got to make sure you do this, so that's why I always try to find the ways to stay out of trouble. So methods for computing Part 5 annual income for no assets. Once all the sources of income are known and verified, the reported income has to be converted to an annual figure. Appendix 16 provides detailed instructions on the various ways to calculate income. The following is a brief summary of how to calculate income. You convert the periodic wages to annual income by multiplying hourly wages by the number of hours worked per year. 2,080 for full-time employment with a 40-hour week with no overtime. That's how many hours are in a, 52 weeks a year times the, okay. Weekly wages by 52, bi-weekly wages paid every other week by 26, semi-monthly wages by 24. This catches people a lot, that difference of those, the 26 to 24. So make sure you know, are you getting paid semi-monthly? Are you getting paid bi-weekly? There's a difference. Monthly wages by 12. Annualize other than full-time income, multiply the wages by the actual number of hours a week the person is expected to work. Because gross pay is going to differ from week to week, you have to determine what average week's pay will be used to project that gross annual income. The following formula should be applied. So this is a exhibit showing you how to calculate anticipated income. List the gross salary earned for each pay stub submitted, noting the week ending date. So that's how you would divide the total amount by the number of stubs to get the average. Total divided by number of stubs equals your your average weekly rate. Multiply the average weekly rate times 52 to get the projected annual income. Divide the projected annual rate by 12 months to get the projected monthly income. Gross income for an individual, also known as gross pay when it's on the paycheck, is an individual's total earnings before taxes or other deductions. So Alice works at the local grocery store and her hours vary from week to week. She submitted the following 4 consecutive pay stubs as income verification. Week 1, 2014 50, week 2, 250 25, week 3, she made a little bit less, 188.50, week 4, 253.50, comes out to 906.75. You're going to take those 906.75 divided by the 4 stubs brings you to 226.69, which was her average weekly rate. You're going to take that, multiply it times 52, which gives you a projected income of $11,787.88. You're going to take that, divide it by 12 months, which brings you to a projected monthly income of $982.32. We have exhibits 411 and 412, which will provide examples that demonstrate how Part 5 annual income definition is applied to individual household circumstances. So you have Clifford Clue, who is a roofer. He works April through September. He doesn't work in rain. He doesn't work in windstorms. His employer can provide information showing the total of regular and overtime hours Clyde worked during the previous 12 months. To calculate his anticipated income, use the average number of regular hours over the most recent 12 months multiplied by his current regular pay rate plus the average number of overtime hours times his current overtime rate. Now, when it comes really interesting is if you pulled my husband's pay stub and if he was to work, because he's a truck driver, he gets Davis-Bacon certain times. Depends, they might have a year with no Davis-Bacon jobs, but if you're projecting, so it's not perfect. We can't do it perfectly, but we can try, okay? Calculating anticipated annual income. A teacher's assistant works 9 months annually. She gets $1,300 a month. During summer recess, the teacher's assistant works for Parks and Recreation for $600 per month. The owner can calculate the family's income using one of two methods. You can calculate her annual income based on that current income, 15,600, 1,300, and you're going to multiply it times 12 months for that yearly rate. The owner would then conduct an interim recertification at the end of the school year to recalculate the family's income during the summer months at a reduced annualized amount of $7,200. It would be the 600 times 12 months. The owner would conduct another interim recertification when the tenant returns to the 9-month job. So you would calculate the annual income based on her anticipated changes through the year. Now, if you did that, she's going to get $1,300 for 9 months, and then she's going to make $600 for 3 months, and it's going to come up to $13,500. Using that second method, they wouldn't have to come back and do an intern recertification at the end of the school year. To use that method effectively, history of income from all sources in the prior years should be available. But I definitely probably, if it was me, after the first year, if they came back and told me they were going to do it again, I would do it using the second method. I might wait the first year to see if that's truly what, that's your call. So, anticipated annual income, tips and practice summary. The requirements for determining whether a family is eligible for assistance, the amount that the family rent that they're going to be required to pay, require housing staff to project or estimate an annual income that the family expects to receive. There are several ways to make a projection. The following are 2 acceptable methods for calculating income anticipated for the upcoming year. Calculate the annual income based on current income. Generally, current circumstances must be considered in order to determine or anticipate income. The projected annual income is calculated by annualizing their current income. Income that may not last for that full 12 months, unemployment compensation should be calculated assuming the current circumstances will last a full 12 months. If changes occur later in the year, an interim recertification can be conducted to change the family's rent. Or you can actually calculate it from the get-go based on anticipated changes through the year. If the information is available on changes expected to occur during the year, That information is used to determine the total anticipated income from all known sources during the year. If the information is available, you can use those present circumstances. So I'm going to use my husband again as an example. When he was a fisherman, he received a stated salary, okay? He worked from April 1st until November 6th of every year. November 15th came around and he would file for unemployment. He would draw 20 weeks of unemployment at the same rate, and then he would go back to fishing. For 26 years, it stayed the same. You know, when they got really big catches or whatever, you would get that, occasional bonus, but you can't prove that with a fisherman anyway. There's certain incomes you just can't prove. But the rest of that was very calculatable, that was another thing. A lot of the fishermen here didn't have internet access. I would help them in the housing authority office. Some of the staff would do it also, come in and help them file their unemployment. Then they were able to, call in. But there are things that require internet in this day and age that some of our tenants don't have. So our housing staff used to help them with that. We also helped, through HUD and the various funding, build like a commodity building. Our commodity building now at the tribe has internet available for our low income people that need to be able to get on the internet to depending on where you're at, you need it to apply for a job in some places, but you definitely need it for filing unemployment. So those are things that you can consider perhaps doing for some of your tribal members. So those are the ways that you can deal with anticipated annual income. Now for your assets, treatment of assets. Some assistance programs require that families spend down assets before they can participate. NAHASDA does not have that asset limitation for participation, okay? Income from assets, though, is recognized as part of the annual income under the Part 5 definition. To comply with Part 5 rules regarding assets, recipients have to know the following. What are you going to include as an asset? How to compute, excuse me, guys, the market and the cash value of those assets. How to determine the income from the asset to be included in annual income. And 2 questions that have to be asked before that household asset can be calculated. First, does the household member have access to the asset that they're listing? Can you get it? Can they get that money if they needed it? Example, a 401k can have certain provisions that prevent an employee from accessing those funds in that account until they've been employed for a certain number of years. That means the employee would not be allowed to withdraw any of those funds at all. That's different from withdrawing the funds and incurring interest and penalties. If you can withdraw the funds, you have access, okay? If not, well. So second, if the total cash value of the household asset is at $5,000 or more, if the total value of the household asset is less than $5,000, then it's not necessary to perform a third-party verification on your assets, and the household can actually self-certify as to the total value of the asset by signing an under $5,000 asset certification form. Also, if the total value of the asset is less than $5,000, then only the actual income from the asset, if any, is counted. If the household's total assets are valued over $5,000, then each asset will need to be third-party verified, and the income from the assets will be determined by comparing the actual total income from the asset and the imputed income using HUD's 6% passbook rate. So what do you include as an asset? In general terms, an asset is a cash or a non-cash item that can be converted to cash. A summary of items that are that are and are not to be considered assets are shown in Exhibit 413. If the income earned, the interest on a savings account, not the value of the asset, that is counted, okay? 6 months of the most current consecutive checking account statements, 1 month of the most current savings account statements are the minimum requirements to document those type of assets. All pages of those statements have to be included, okay? They have to give you the whole thing. So, included savings accounts, checking accounts, money market accounts, 401k, IRAs, real estate ownership, mutual funds, and whole life insurance. Excluded personal property, vehicles used on a regular basis. Would be different than a show car sitting in a garage or something, in mint condition, never driven. Jewelry, furniture, clothing. Interest on trust land is excluded. Assets that you lose in a divorce, foreclosure, or a bankruptcy. Assets disposed of for fair market value. Term life insurance. Assets that are not accessible by the applicant. Exhibits 414 through 421 provide examples that demonstrate how income from assets is calculated. Market value and cash value assets both have a market value and a cash value. A market value of an asset is simply its dollar value on the open market. For example, the market value of a share of stock is the price quoted on the stock exchange on a particular day. A property market's value is the amount it would sell for on the open market. It can be determined by comparing the property with similar, recently sold properties, comps. Okay. An asset cash value is the market value less reasonable expenses required to convert that asset to cash, including penalties for or fees for converting those financial holdings. Any penalties, fees, or transactions, charges that are levied when an asset is converted to cash are deducted from the market value to determine its cash value, including, the penalties charged for premature withdrawal of a certificate of deposit, the transaction fee for converting a mutual fund to cash, or broker fees for converting those stocks to cash. Cost for selling real property, settlement cost, real estate transaction fees, payment of mortgages and liens against that property, any legal fees associated with the sale of those real properties are deducted from that market value to determine that equity in that real estate. So what to include as an asset? Under the rules of Part 5, only the cash value rather than the market value of an item is counted as an asset. If more than one person owns an asset, recipients have to prorate the asset according to the applicant's percentage of ownership. If no percentage is specified or provided by state or local law, recipients have to prorate the asset evenly among all the owners. If an asset is not effectively owned by an individual, you don't count it as an asset. Actual income from assets. They can generate income, and for the purposes of determining an applicant's income, the actual income generated by that asset, the interest on a savings or a checking account, is what counts, not the value of the asset. So if I have $1,000 account, you don't count the $1,000, you count the $14 that they give me. You never get $14 off $1,000. $14 that you would, generate from that 1,000, not the 1,000 itself. The income is counted even if the household elects not to receive it For example, if an applicant elects to reinvest that interest or dividends from an asset, it's still counted as income. As with other types of income, the income included in annual income calculations, the income that's anticipated to be received from that asset during the coming 12 months. Several methods can be used to approximate the anticipated income from that asset. Many recipients are surprised to learn that the checking account balances, as well as the savings account balances, are considered an asset. This rule is not intended to count that monthly income as an asset. Rather, it's recognition that some households keep assets in their checking accounts. To avoid counting monthly income as an asset, recipients must use the average monthly balance over a 6-month period as the cash value of that checking account. To obtain interest on a savings account, the current account balance can be multiplied by the current interest rate applicable to the account. Alternately, if that value of the account is not anticipated to change soon, the interest rate has been stable, a copy of the IRS 1099 form showing the past interest earned can be used. Assets which are owned jointly. If assets are owned by more than one person, prorate the asset accordingly to the percentage of ownership. If no percentage is specified or provided by local, state or local law, prorate the asset evenly among all the owners. If it's not effectively owned by an individual, again, you don't count it. When the asset is held in an individual's name, but the asset and any income it earns accrue to the benefit of someone else who is not a member of that family, and the other person is responsible for the income taxes incurred on that, income generated by that asset, you wouldn't count it. So your assets owned jointly. Determining which individuals have ownership of an asset requires collecting as much information as possible, and making it available and making the best judgment possible based on that information. In some instances, but not all, knowing whose Social Security number relates to the asset can help actually identify that ownership. Recipients should be aware that there are many situations in which Social Security numbers connected with an asset does not necessarily indicate ownership, and other situations where there's ownership without connection to a Social Security number. Determining who has contributed to an asset, who is paying taxes on the asset, should help identify the ownership. So who's paying the taxes on that piece of property? For many assets, calculating cash value and the income from the assets is pretty straightforward. Special rules, however, have been established to address 2 different circumstances. Situations in which the assets produce little or no income, and assets that are disposed of for less than fair market value. When an asset produces little or no income, this rule assumes that that household with the asset has an increased payment ability, even though those assets do not currently produce income. Exhibit 414 will illustrate that rule. When calculating income from assets, use that 6% of the passbook rate, HUD passbook rate. This rule only applies if the total cash value of all the assets is more than $5,000. The following examples illustrate how imputed income from assets and that calculation is applied. For example, a household owns land that is not rented or otherwise used to produce income. Rather than require the household to dispose of the property, the rule requires that an imputed income be collected based on a passbook rate that is applied to the cash value of all assets. So, the Mark family has $6,000. It's their average balance over a 6-month period in a non-interest bearing checking account. The recipient would include an annual income amount based on the current passbook rate. The calculation would be 6,000 times that 0.06. So it would be $360 worth of asset income you would count. Not the 6,000, that 360. So the Hernandez families has 3,000, which is their average balance over 3 months in a non-interest bearing checking account, and 5,500 in an interest bearing savings account. The family reports and the recipient verifies $150 worth of interest on that savings account. The recipient would count the greater of the actual income from assets or the imputed income based on that passbook rate, as shown below. So the imputed income on 8,500 times 0.06 is $510. The actual income they verified is $150. Unfortunately, you have to include in the annual income that passbook rate, so $510. The Smiths have a $600 average balance over 6 months in a non-interest bearing checking account. No income from assets would be counted because the family has no actual income from that asset, and the total amount of all assets is less than $500 or $5,000 because it's only 600. So that one's a wipe. Okay, when assets are disposed of at less than fair market value. I told you today's the long day for me. I guess I should be glad it's a Wednesday because then it'll go. Applicants who dispose of assets for less than fair market value, the value on the open market, okay, is an arm's length transaction. They voluntarily reduce their ability to afford housing. The Part 5 rule would require that any asset disposed of for less than fair market value during the 2 years preceding the income determination would be counted as if that household still owned that asset. So the amount to be included as an asset is the difference between the cash value of the asset and the amount that was received, if any, in the disposition, the selling of that asset. Consider the following example. Each applicant has to certify whether an asset has been disposed of for less than fair market value. Assets disposed of for less than fair market value because of a foreclosure or a bankruptcy are not included within that calculation. In the case of a disposition as part of a separation or a divorce settlement, the disposition will not be less than the fair market value if the applicant receives or received important consideration not measurable in dollar terms. So, Mr. Jones cashed in stock to give his granddaughter funds for college in August of 2021. The stock had a market value of $4,500 and broker fees of $500 were charged to that transaction. The market value was $4,500 less the broker's fee of $500. The cash value to be considered would be $4,000. The $4,000 in assets would be counted for any income determination conducted for 2 years so it would be August of 2023, looking forward from the time of disposal. If Mr. Jones has no other assets, no income from assets would be included because that cash value is under $5,000, okay? If other assets brought his total assets to more than $5,000, however, your imputed income calculation described previously would be required. Then it would kick over your 5,000 mark. So, example 2, Mrs. Dutch. She sold a piece of property to a family member for $30,000 in 2016. That home was valued at $75,000 and had no loans against it. The market value was $75,000, less the settlement cost of $3,000, less the sale price. She sold that thing for $30,000. So the cash value to be considered would be $42,000. The $42,000 would be counted as an asset for any income determination conducted until 2018. So you're going forward 2016 to 18, those 2 years. The 42,000 would be combined with the cash value of other assets if she has it, and an imputed income calculation would be required. So, summary of the items that need to be considered when you calculate asset income. Are the total household assets under 5,000? If the answer is yes, then you have no need to obtain third-party verification. Only the actual income from that asset, if any, is added to the household income. If the answer is no, all the assets have to be third-party verified, and the greater of the actual asset versus the imputed asset income must be used. You use that HUD 6% passbook rate added to the household income. Asset income is determined using the interest, dividends, rent, etc. to calculate the amount that that asset is earning. If the asset does not earn income, it's a non-interest bearing checking account, for instance, then there is no income from that asset. Count asset income for all assets held by household members, including the assets of minor children. Under $5,000, asset certifications have to be executed by all adult household members when the total value of the household asset is less than $5,000. So, a third-person household, a three-person household, a third-person household, 2 adults, 1 child, list the following assets on their application. The head of household has $200 in a savings account with a 0.50% interest rate. The minor child has $100 in a savings account with a 0.50% interest rate. Calculation: 200 times the 0.50 equals $1. The 100 times the 0.50 equals 50 cents. The total asset or income for the household for their assets is $1.50. A 4-person household, 2 adults, 2 children, listed the following assets on their application. The head of household has $2,000 in a savings account with a 1% interest. The spouse has $2,500 in a money market account with that same 1%. Minor child 1 has $1,000 in a savings account with a 1%. Minor child 2 has $1,000 in a savings account with a 1%. The calculation: total household assets is $6,500. You do the calculations at the 1%, comes up to $65. The imputed asset calculation, that's $6,500 worth of assets times that passbook account at 6% is $390. So the household's total asset value exceeded $5,000, which then triggered that HUD passbook rate calculation. So the imputed asset income is greater than the actual income. So $390 would be added to that household's total income, gross income. So, anticipated annual income, tips, and practice. The requirements for determining whether a family is eligible for assistance and the amount of rent the family will pay require housing staff to project the estimated annual income that that family expects to receive. Several ways to make that projection. Following are 2 acceptable methods for calculating annual income anticipated for the following year. Calculate the annual income based on current income. Generally, current circumstances must be considered in order to determine anticipated income. The projected annual income is calculated by annualizing current income. Income that may not last for a full 12 months, unemployment compensation should be calculated assuming that it's going to last for 12 months. If changes occur later in the year, an interim recertification can be conducted to change the family's rent. You would tell them, make it pretty clear. When you quit receiving your unemployment, come on back in and we're going to recalculate this. Or you calculate that annual income based on your anticipated changes throughout the year. If the information is available on changes, that is expected to occur during that year, that the information is used to determine the total anticipated income from all known sources during the year. If the information is available, use that present circumstance. But tell them, which way you're gonna do that. So U.S. Census definition of income. Annual income is the algebraic sum of all amounts received by a family or a household, including head or spouse and other persons 15 years old and over when you're using the census definition, okay? Residing in the household, regardless of the relationship for that 12-month period. Annual income includes, but is not limited to, wages of salary income, includes the total money earnings received for work performed as an employee during the calendar year. It includes wages, salary, armed forces pay, commissions, tips, piece rate, payments, and cash bonuses earned before deductions were made for taxes, bonds, pensions, union dues, etc. Non-farm self-employment income includes net money income, gross receipts minus the expenses from one's business, professional enterprise, or partnership. Gross receipts include the value of all goods sold and services rendered. Expenses include cost of goods purchased, rent, heat, light, power, depreciation charges, wages, salaries paid, business taxes, not personal income taxes, etc. Farm self-employment income includes net money income, gross receipts minus operating expenses from the operation of a farm by a person or on his or her account, an owner, a renter, or a sharecropper. Gross receipts include the value of all products sold, government farm programs, money received from the rental of farm equipment to others, and incidental receipts from the sale of wood, sand, gravel, etc. Operating expenses include cost of feed, fertilizer, seed, and other farming supplies, cash wages paid to farm hands, depreciation charges, cash, rent, interest on farm mortgages, farm building repairs, farm taxes, not state and federal personal income taxes. Again, the value of fuel, food, and other farm products being used for the family living is not included as part of that income. Dividend. Interest, dividend, or net rental income includes interest on savings bonds, dividends from stock holdings, membership in associations, net income from rents of properties or others and to others, and receipts from boarders or lodgers, net royalties, periodic payments from an estate or a trust fund. And then you have Social Security income. Includes Social Security pensions, survivors benefits, permanent disability insurance payments made by the Social Security Administration prior to deductions for medical insurance, railroad retirement, and railroad retirement insurance checks from the U.S. government. Medicare reimbursements are not included. So, public assistance income includes supplementary security income payments made by a federal or state welfare agency to low-income persons who are age 65 or older, blind, or disabled. Aid to families with dependent children, GA assistance, separate payments received for hospital or other medical care. Vendor payments are excluded from that item. Retirement and disability income includes retirement pensions, survivor benefits, former employee, former employer, labor union, federal, state, county, or other government agency, disability income from sources such as workers' comp, companies or unions, federal, state, or local government, the U.S. military, periodic receipts from annuities, insurance, regular income from IRA, and I can never say this, cow plans. I still can't say it. KEOGH plans. So, U.S. definition still, other incomes include unemployment, veterans, or your VA payments, alimony, child support, contributions received periodically from persons that don't live in your household, military family allotments, net gambling winnings, guys, and periodic income other than earning. Annual income does not include money received from the sale of a property unless the recipient was engaged in the business of selling property, the value of in-kind from food, stamps, public housing subsidies, medical care, and employee contributions, withdrawal of bank deposits, money borrowed, tax refunds, exchange of money between relatives living in the same household, gifts and lump sum inheritances, insurance payments, and other types of lump sum receipts. So, the Internal Revenue Service definition of income. The IRS adjusted gross income means gross income minus deductions, including the following. Because a trade or business carried on by your taxpayer, except for services as an employee, the Internal Revenue Manual, paragraph 1006, for trade or business expenses paid or incurred by a qualifying performing artist for services in the performing arts as an employee, allowed as losses from the sale or exchange of property. You would look at IRM paragraph 1701 for expenses paid or incurred in connection with the performances or services as an employee under a reimbursement or other expense allowance arrangement with the employer or third party. Employee expenses that are not reimbursed under the accountable plan are not deductible from gross income. Attributable to rental or royalty property or for depreciation or depletion allowed to a life tenant of a property or to an income beneficiary of a property held in trust or to an heir, legatee, or devisee of an estate. You have to be a lawyer to get through and comprehend. I mean, you have to read this multiple times, and hopefully your A&O staff is in place for a long, long time, because it takes a lot to learn. So your Internal Revenue Service, but the good thing is if you're only using one definition, you only have to learn one set of these rules. And if you're using all three, you have to learn them all. So, Internal Revenue Service, definition of income, contributions by self-employed persons to pension, profit sharing, and annuity plans, allowed for cash payments to individual retirement accounts, your IRAs, deductions allowed for cash payments to retirement savings plans of certain married individuals to cover non-working spouse, for the ordinary income portion of a lump sum distribution to the extent excluded in gross income, for interest forfeited to a bank, savings association on premature withdrawals, time savings accounts or deposits, for alimony payments, for the amortization of reforestation expenses, for certain repayments of supplemental unemployment compensation benefits, to a trust described within Code Section 501, C9 or 17, required because of a receipt of trade readjustment allowances. It's a lot. Jury duty paid, remitted to an employer, moving expenses for the purchase of clean fuel vehicles, interest on education loans incurred on, before, or after August 5th of 1997 with respect to loan interest payments, contributions to medical savings allowed by Code Section 220 for expenses paid or incurred by a fee basis state or local government official for services performed. Note, the adjusted gross income figure is found on line 7 of your 1040 form. besides for all that, that one's really easy to kind of figure out. So comparing the three definition, those major differences between the HUD Section 8, the Census Long Form, and your IRS Form 1040, definitions of annual income can be broken into the following categories. There's an Exhibit 4.22 that'll show you that. A reminder about using those definitions. It can allow more than three. You have to ensure your applicants to those programs and activities are treated equitably. So you have to make sure you run that all three ways. Whose income counts? The answer to that question depends on which definition you're going to adopt in the specific program requirement. Remember that earned income and unearned income counts, but not for all ages. For example, unearned income is gaming dividends that have to be counted to determine eligibility. However, your policy can allow for the exclusion of gaming dividends in the calculation of the monthly rent payment. It's up to where you're at. Or you can show them your losings too, and you do it like the IRS kind of does, you know, what do they have to pay in? So Exhibit 422, comparing the three definitions. Many housing programs have the most experience with that HUD Section 8, that definition of annual income, and have developed administrative procedures and forms based on those rules and requirements. The HUD Section 8 definition has been used for many years in various HUD programs, such as Section 8 and public housing. HUD Section 8 definition is also used in the Low Income Housing Tax Credit Program, which is often used in combination with our IHBG funding for our low rent projects. The types of income to count, there are also some differences between those three definitions that can result in different income calculations. The three most significant differences between those definitions: child support payments are not included on the IRS Form 1040 definition of income. The IRS Form 1040 definition allows for the deduction of alimony payments. Inheritance and insurance settlements are included in the HUD Section 8 asset calculation, but not included if you're using that census or the IRS definition of annual income. Treatment of assets, your HUD Section 8 definition of annual income requires special computations concerning assets. The Census Long Form and the IRS 1040 definitions do not require special calculations. However, income from certain kinds of assets may be included under those two definitions. Okay, so calculating adjusted gross income. We are supposed to be done for the day, so I am going to add this part onto tomorrow's. But when you go to download these presentations, this will be found under day 3. Okay. We have just too many for me to get through. Like I said, this is the hardest day. Okay. So, do you have any questions? Is anybody there? Did I lose you?
I'm gonna go ahead and start closing up. If anyone has questions, please go ahead and enter them in the chat box. Crystal, are there any questions? Crystal is currently frozen. I'm gonna go ahead and read out those questions.
Okay.
How and where do we get the affidavit?
Affidavit.
That is question number 1.
Okay, can you tell me what the affidavit is for?
Before that, he mentioned nitpicking on SS payments. Dorothy, if you would like to,
Can you chat?
she
Either
says, I was wondering about the 3 definitions. Do we pick 1, 2, or all 3?
that's that. The thing about the 3 definitions, sweetheart, is you have to make a tribal determination, whether it be your housing board or your tribal council, whoever you're under, and you go by that definition. Or you have the ability to say that you're going to use all 3 definitions, which some people do. Whichever method is most advantageous either to the tenant or to the housing entity. But when you do that, you have to know the rules for all 3 of them, and you have to run all that stuff each way and keep proof. So, I would go back and look and ask within your other people, within your admissions and occupancy, if you're currently running, which definition that you have adopted. You should also probably be able to find that through your HDS if you're using that. But you can see all the explanations on those appendix items. That the one about calculating rent that's referred to here will show you the difference of all of those. You understand that?
Oops, sorry. I did not realize my mic was muted. She hasn't responded yet, but while we wait for her to say anything, the next question is, do we include SSI for a 13-year-old who is on temporary disability?
What that's hard for me to
Mariah, if you're still in the chat, would you like
no,
to?
it's just hard for me to answer that question without being able to know, certain things about their program. Ask them to call the HUD office on that one.
Okay, I will go ahead and message her.
And you are right, Patty, it's a lot to take in and during one thing. I would definitely suggest you take a week, the week-long all-day classes on that. They're usually offered by a couple of the organizations, but it's 3 or 4 days and they're 8-hour days. It's a lot. It's a lot for people to take in.
And we have one more question. It is, what if a HOH is on SS and has adult child living with him and is going to school?
You would, if the adult child is going to school, it depends on if he is considered a dependent or not. You use the student and then you would count their income. Depending on if he's listed as a co-head or if he's just like somebody living with them. If he's just living with them, you do that deduction and you only take that portion of his salary. I don't think if he's an adult, you would be giving him a dependent deduction though. Because you didn't tell me if he worked either. I don't have enough of the scenario to be giving, questions like that. So can you count his income? If the student is employed, and he's working full-time. But is he going to school full-time? Is he head of the household? It's hard for me to answer that, not, you know what I'm saying? Student, yes. Full-time, yes.
And then I have one more, another question. What is SSDI? Is it counted?
Social Security, disability?
Yeah, this is Georgette, Cheryl. I think what Mariah was trying to ask is if she can include SSI for a 13-year-old who is temporarily disabled, who has temporary disability.
If it's only a temporary disability, he shouldn't be getting money for it. If that makes any sense to you, but
Okay,
I
Mariah.
would, yeah, under this circumstance, honey, I think you need to call your HUD office and ask them. I don't want to give you anything that's improper. I don't know enough about that situation, and they can ask you. And they can ask you what definition you're using and all that fun stuff. It's really hard. I don't want to lead you the wrong way.
Perfect. Thank you.
Thank you, G. And Roseanne, if I were you, I would also just let us know a little bit more about your question, so that way we can really narrow it down.
It's really hard under these scenarios, under this, because I don't know which definition they're using. I don't know enough about the family, and I don't want to steer them the wrong way. Whereas if they have somebody that they call HUD for advice, they can give them all the information legally, you know, where they shouldn't be sharing that over this type of a.
And then Dorothy would just like to clarify, so the definition should be in our policies?
Yes, they have to be in your policies. Which one you're using. If it's not, you need to rewrite your policies. But chances are you're using housing data and you're going to find it there also.
Thank you once again, Cheryl, for answering all
no
the
worries.
questions and for presenting today. Really do appreciate it.
Oh, no worries, my girl. You guys all stay safe.
I went
Gigi.
ahead. Thank you. I went ahead and posted the survey as well. If you guys could just go ahead and let us know how we did, how you liked the presentation, if there's anything we can do to make it easier on your side, please go ahead and let us know. And thank you once again, everyone, for joining us today.
I'll see you guys tomorrow.